Nope, that's not chapter 3. Here's chapter 3. And we're going to do two things. One thing is real easy, and the other thing is really hard. So let's start with a really easy one first. Basically, if you own shares of stock in a company, one of the things that you may be wondering is, well, how much is my investment earning? What is it? What are the earnings that I'm getting on my investment in this company? And so that's what kind of we're talking about here is the earnings per share. And it can be a little bit, if you're wondering why we do it this way, it's because different people own different number of shares. You know, maybe I own 10 shares of stock. Maybe you own 200 shares of stock. Maybe someone else owns 5,000 shares of stock. So it's going to be different for each one of us, but you might hear dogs barking. But it's going to be different for each one of us because the number of shares we have. So you say, okay, how much is it per share? So that's why we have this per share thing, is because people will have different amounts of ownership. Okay. So they reported net income of 120,000 shares. Okay, so they had 20,000 shares of stock. That was how much was outstanding. But now these employees have stock options that they can actually buy more shares of stock. So notice that the question is, okay, these shares of stock that the employees can buy, they haven't done it yet, but they could. And so obviously, if there are more shares out, that means the income gets spread out over more shares. So there are basically going to be a couple different calculations. One is for the number of shares that are outstanding right now, and the other one is what they call diluted, in that it will include those shares that other people could buy, in this case, the employees. They could exercise options. Okay, so space in here. So, okay, so the first one is just going to be for the 20,000 shares of stock. So earnings is 120,000. And the number of shares that's actually out there right now is 20,000. So the earnings per share would be $6. Now for the diluted ones, lazy here. For the diluted ones, we have 20,000 plus we have this 5,000, so it's possible they have 25,000. In that case, it'd be $4.80 per share. So if everybody actually exercised their shares of stock, if they all went and exercise these stock options and get the extra 5,000 shares, it would dilute it. And you'll notice that instead of $6 a share, we would get $4.80 a share. Okay, then so that, again, that's just basically right. Oh, here's one thing I do want to point out, though. I can't format this thing very well. Net income and earnings are the same thing. So whenever you see net income and or earnings, it's the same thing. Sometimes you see it called net earnings. Sometimes you'll see net income per share, so earnings per share. They're exactly the same thing. Most companies call them earnings, and most textbooks call it net income for some reason. But you know, so earnings and net income are exactly the same thing. So when you see it in a financial statement, earnings, it's the same thing as net income, and net income is the same thing as earnings. So. Okay, now for the most difficult thing we will do, actually one of the most difficult things in accounting are the statements of cash flows. The first three statements that we learned how to do was the income statement, statement of retained earnings, and the balance sheet. Excuse me. Those three statements have been around for 500 years. They've been around for, forever. So those are very common to everybody. The statement of cash flows is about 40 years old. So it's fairly new as far as 40 years is a long time, but compared to the other ones that have been around for hundreds of years, it's kind of like the new kid on the block. But it's basically tells people what happened to the cash. People will look at the financial statements and say, okay, the cash has changed, it's gone up, it's gone down. Well, how did they get there? And the reason why we're so focused on cash is that for a number of reasons, but cash is like blood. And companies, basically, if they run out of cash, they run out of blood, they die. There are numerous cases of companies that were profitable, ran out of cash and went bankrupt because, even though they're profitable, they ran out of cash. So cash is really important to a business. And basically everything at some point in time pretty much runs through cash. If you buy equipment, if you buy inventory, if you pay employees, it's difficult to actually come up with a transaction that doesn't include cash at some point. So because of that, because it's such an important part that the statement of cash flows. Now, it's very, it's a tough financial statement to make. Companies have made mistakes. Big companies, General Motors has made the mistakes putting out their statement of cash flow because there's a lot going on with them. But the idea is that they will explain what happened to the cash. Now, the way that I'm going to show you guys is called the indirect method. There are two methods. There are direct method and the indirect method. If you do the direct method, you also have to do the indirect method. So you'd have two statement of cash flows, where if you just do the indirect method, that's all you need. So most companies, not all, will do just the indirect method. Some will do both. But for our purposes, I'll put it to you this way. Because if you do the direct method, you also have to do the indirect. You always have to do the indirect method. I know it sounds funny because you think indirect wouldn't be as good, but actually, it's a pretty good document. Okay, there are three sections to it. And if you go to the second thing here, we have the three sections. We have the operating, investing, and the finance. Okay. This is not very good. I'll fix this before I send it out. But so the financing cash flow, the operating cash flows, investing cash flows, and financing cash flows. And these are the three sections that they basically have. And we're going to go through each of these separately. And then the last one is putting them all together. And that's much more difficult. But we'll do these separately and go from there. Okay. All right, over here for the statement of cash flows. I think I'm going to bold this. We take the net income first. So we start out with a net income. So we're going to do that over here. Over here we have net income. This is for the operating section. We add back depreciation or amortization expense. There's a strange thing about depreciation, that there's no cash involved. If you buy a car for $20,000 and you drive it off the lot, When you drive off the lot, it's gone down in value, it's depreciated, it's going down. So let's say that you buy a car for $20,000 and the next year it's worth $17,000. So it's decreased in value by $3,000. Notice that no cash has changed hands. You didn't write a check to somebody for $3,000. So depreciation doesn't actually have any cash. You hear about paper losses, this is what they're talking about. That even though they show as an expense on the income statement, depreciation expense, there actually is no cash outlay for it. So when we do the statement of cash flow, we're trying to get back to just the cash. We say, okay, we subtracted this to get the net income. We got to add it back in because there was no check written for the depreciation. Okay, so depreciation expense, it always gets added back in. Okay, and now for the most confusing part on the whole class. We have what they call current assets. Let's make these, I don't know what color. And we'll make these some other color. Okay. These are all short-term assets. Current assets. These are current assets. And these are current liabilities. These are liabilities that are short-term that last for less than a year. Okay. Now we separate out between current these assets. And by the way, you can just use the accounts they have here. Figure it out. But we have these accounts and it depends on whether they're assets or liabilities. And basically, assets go in the reverse order when it comes to cash flows. And here, let me explain why. If I got this boat, again, I'm going to sell it. This is an asset. So if I sell the boat, the asset, this boat, the inventory goes down, right? My cash goes up because I sold it. So if an asset category goes down, your cash goes up. Just the opposite. If a category goes up, okay, let's say that I buy more inventory, I buy more boats. Well, my cash is going to go down because I have to pay for those boats. So if inventory goes up, cash goes down. Inventory goes down, cash goes up. So it goes in the opposite direction for assets. So let's get back to our problem. Ooh, I almost quit this. All right, so accounts receivable increased. We come over here, increases get subtracted. So this will be minus. Prepaid items are here. So if you prepay something in advance. So it's an asset. It decreased. So it'll go in the opposite direction. It will actually increase. So notice that these are assets. And they go in the opposite direction. If the account increases, cash goes down. If the account decreases, cash goes up. It's just the opposite for accounts payable. And for liabilities. They go in the same direction. I'll explain why in a second. Oh wait, these are decreased. I'm sorry, I said that wrong. I wrote it in wrong. These decreased. No, I did it right. See, I'm confusing myself. And I made this thing. So these are liabilities. And they go in the same direction. Ask why? Well, the reason for the liabilities is how do liabilities go down? When you owe somebody something, how do you reduce that? How do you reduce what you owe them? You pay them. So the only way liabilities go down is if your cash goes down. If you pay them, you don't owe them as much. You know, you're paying off your bill, but you also have less cash. So cash goes down with life. So for assets, it goes in the opposite direction. For liabilities, it goes in the same direction. It'll go, you know, up or down. And so this will be the net operating cash flows. Okay, so let's go to this next one. Start out the same, net income, depreciation. There actually is a gain here. The gain is 1,200. Now notice the gains get subtracted. I'll tell you why in a second. Gains get subtracted because we're actually going to have that in a different section. gains come about because of sales, gains and losses come about because of sales of term assets. And those will be in the investing section. So we're subtracting that one because it's gonna go into a different section. We're gonna take it out of current section it's in and put it in a different section. So that's why it's being reversed out. Okay, so let's see what assets we have. Accounts receivable. Inventory. Okay. So these are both assets. They both decrease, assets go in the opposite direction. So they will increase. Liabilities. Accounts payable. Taxes payable. And these go in the same direction. So accounts payable increased. Taxes payable decreased. These are liabilities. Oops, hold on. Okay, so if you have these two companies, while this one has lower net income, right, they have more cash coming in. And cash is really important. Oops. Okay. Coming down here, we have to, I'm gonna move this down. Down here, we just have to do a little calculating. Okay. Start out the same, net income. Depreciation expense. Plus losses. So kind of a weird one, kind of similar to the gain. Will actually be a plus. All right, now we have these two. So accounts receivable, that's an asset. And it went from 10,000 to 11,600, so it increased. An asset, it goes in the opposite direction. That means that would have to decrease. So it went up by, let's see here. $1,500 increase. Oh, our cash should go down with that. And payable increase. Let's see. I'm gonna copy this. $19,800 minus $18,600. What is that? 1,200. The liabilities go in the same direction. Much of this stuff is hard. It's a whack way of thinking of things. You got to kind of change your mind around to start thinking about just how cash comes in and how cash goes out based on different accounts. But the thing, the wacky thing about the operating cash flows is, and actually for the other ones too, you will find out, is that when assets go down, cash goes up. Assets go up, means you must have bought them, cash goes down. So it's the opposite direction. Liabilities go in the same direction as cash. If you borrow money from the bank, you owe more money, your liabilities go up, but you have more cash, whatever cash you borrowed from. How do you pay off those? You pay with cash. So if your liabilities go down, your cash goes down. The only way to get rid of the liabilities is to pay them. So it's kind of a weird way of thinking about it, but okay. Number 4 has about everything in it. We have net income. We have depreciation expense. We have amortization expense. It's in there too. Depreciation and amortization expense. Amortizations are like depreciating intangibles, things like copyrights. Gain on sale of assets. Gains get subtracted. Another wacky thing. Because there's a gain in here for 30, in that $38,000 income, there's a $10,000 gain, but that's gonna go into a different section. Okay. Inventory decrease, it went from 30,000 on 26. Inventory decrease, must have sold the inventory or cash goes up. Accrued taxes, accrued taxes, accrued expenses, those are all liabilities. So accrued taxes, let me put it here. Let me put 1,000. If it's a liability and it decreased, you must have paid it. Oh, I didn't do the net operating cash flows over here. I'm sorry. Let's do those. Make sure you fill that in, even though I forgot. Fill that one in. Number 3. Okay, the investing section. The investing section is when you're buying and selling long-term assets, things like land, equipment, buildings, those sorts of things. Buying and selling those things are your investing section. In other words, making investments in big things like land, building, equipment, all that kind of stuff, long-term stuff, cars, vehicles, all that kind of stuff. Okay, so let's go through each of these. Oops. Acquired of doesn't even make sense. Acquired plant assets, I guess. Let's take the of out of that. Acquired plant assets. When we acquire something, it means you bought. And so your cash goes down. Sold land with a book value of 10,000 for a $2,400 gain. Second here. Okay, well, if it had a value of 10,000 and we have a $2,400 gain, so that would be look at $12,400 cash, so that'll be a plus. Trading investments. This is a trick question. Trading investments do not go in here. These are short term, so they do not go in there. It would actually go in the section we just did, the operating section. Sold available for sale securities. For value, the carry value of 17,000, sold for $16,000 cash. How much cash we get? 16,100. Purchase equipment for 9,000. It's gone down by 9,000. All the equipment that cost, blah, blah, blah. We sold it for $2,200 cash. $2,200. Purchased investments. By the way, the investing cash flows are usually negative. And if a company is staying the same size or growing, that'll be negative. It's one of the weird things in that for a company to be healthy, you expect it to be negative. You want them to invest money, but you open new stores and all that kind of stuff. So being negative in the investing area is a good thing. Okay, financing section. That's over here. And basically, it's if anything, it's increasing. They go kind of hand in hand. If you increase your liabilities, your cash increase. If you decrease, it means you're paying it off. Same thing here. Okay. And dividends are also in there. They're always negative. Okay. Payment of dividends. Whenever you pay a dividend, your cash goes down. Sold treasury stock. Whenever you sell something, your cash goes up. Issuance of common stock. This means we sold it. And if we sold it, that means it goes up. Issued notes payable. So this is going up. Liability going up. Now, notice something here, and that is that it's 90 days, it's a 90-day note. We normally say, okay, that's short term. Should that go with operating? Generally, no. If it's a note, virtually all the notes are going to go with the in the financing section, because they're usually issued to get cash as a financing operation, not necessarily just to get inventory like accounts payable would be or something like that. So issued notes payable, our cash goes up by 11,000. Okay, issuance of unpayable, this is a liability increasing or cash increases. Retired bond payable, this is when we pay off the bonds payable. So it's going to decrease. Repayment of short-term loan. Okay, we paid the loan, so our cash is going to go down. Purchase the treasury stock. Well, we purchased it, so our cash is going to go down. Okay. So these are the three sections. I know they're confusing. We just kind of ran through these. Okay, the last thing we're going to do is kind of putting them all together, and this will be a statement of cash flows, and you'll have one similar to this in your homework. And we're going to have to figure out a few items that they don't give us. And the reason I'm doing this is not because I would do it this way, but that's the way that they show it in the book. That's the problem. So I'm going to show you how you kind of figure this out. There's a couple of missing numbers here. Okay. Well, net income, we don't know. So we're going to try to figure out what net income is. Now we're going to do it with this account right here. Retained earnings. Now notice that the ending 2021 retained earnings will be the beginning retained earnings of 2022. So this will be the beginning and this will be the ending. Okay, now we know retained earnings. We start with the beginning retained earnings. And so that would have been 7,800. We would add net income. Now, we don't know what net income is. So I'm just going to put it in a 0. Now, I'll show you we do that later. Cash dividends paid. Negative. Okay, so this will give us our any retained earnings without net income. So now, we actually have our ending retained earnings with net income is 8,700. Now, I know that this one's wrong. Let's not do that part. I know this one's wrong. It's off by the net income. So if we take the difference between those two, I'm going to take 8,700 minus. So this must be our net income. Now our depreciation expense. We're going to use this to figure that out. Oh, it's too dark. Hold on. Notice our depreciation went from 2,000 to 2,345. So it's a difference of 345. This must be our depreciation. So we figured out our two missing numbers here. And now we can jump into our I don't think I made this anywhere big enough. Well, we'll give it a shot. Okay, so start out with our net income. Depreciation expense. Coming over here, let's see here. We have to see if these increase or decrease. So this will be an increase. Okay, accounts receivable increased, so cash will go down. In case you're wondering, that is not highest bill increased. So inventory decrease, so these are all assets. Here it is for now. We also have accounts payable. Accounts payable decreased. And after liability. And liabilities, they go down together. So this decreased by what, 525? Okay. Investing cash flows. Machinery increased by 3,000. I'll find a color for you. And financing cash flows. Long-term debt and common stock both increased, so our cash will increase. Common stock increase and units to sold more common stock. Cash goes up. Oh, wait, we got dividends here too. Dividends paid, negative. Okay. Okay, so we're gonna see here, and this is kind of where it becomes a little bit interesting. Okay, net cash flow is 450. This is actually a very interesting number. And show you why. If you come up here, our beginning cash was 2,700. So if we add those two together, we should come up with the ending cash. And we do, so notice this. Let's get the color for that. Ah. No. Color do we use? Doggone it. I know, I'm just gonna make these all the same. Oops. Okay, so notice that this cash, it explains this cash account, how it went up. So let me just do it with the. So it explains what happened to the cash. It went from 2,700 to 3,150. And that is basically because of, all the cash flows together will explain what happened to the cash. Okay, now this last one is very similar to the one that you get on your homework assignment. I know it's complex, it's confusing. And hopefully you can see why, it's not out of the question that even people that know what they're doing will make errors. But anyway, so that's the statement of cash flows. And again, you can go ahead and read up more on it. And if you want more help on it too, I'm also available. If you just contact me and we can set up sessions to go through. I actually have quite a bit of stuff on statement of cash flows. They do take time though, and it's not unusual for statement of cash flows to take an hour each. So which is a little tough in a class that's only 5 weeks long. So anyway, that is the chapter 3 handout, and I will see you for the chapter 4 handout.